Alright, so welcome to the first video of Fail Safe Wealth, where we will show you how to invest your money and do other things to bring in more income with your money, make your money work for you. So on this page, you'll find out how to start a brokerage account to start investing in stocks, bonds, mutual funds, index funds, ETFs, and all that good stuff. And also how to start other companies, get an LLC going, tax write-offs, all that good stuff. So first today, I'm gonna teach you how to start a brokerage account so that you can start investing in stocks, and how to find stocks, analyze stocks, and things you need to look at in a company to see if that's a good fit for you. So before you can start investing, you have to open up what's called a brokerage account. And I use Fidelity myself, but you can use TD Ameritrade, Charles Schwab, or Robinhood, apps like Robinhood to start investing. So once you open your brokerage account, in order to start looking for certain stocks, if you want to look at certain stocks, you have to know what's called a ticker symbol, and that's how you search for a stock. So I know like Delta Airlines use ticker symbol DAL, AT&T might use ticker symbol just the letter T, and like if you want to invest in Coca-Cola, then you would put in the ticker symbol KO, and that's how you start looking for stock. Now, once you pull up that stock page, you'll see what's called an overview, and every company uses an overview, which is like a snapshot of that company. So what you do looking for in the snapshot is you want to look at the market cap, the PE, which is the price to earnings ratio, the EPS, which is the earnings per share, the dividend yield, and the payout ratio. And I'm going to say you don't want to look at the chart because it really doesn't mean anything. Because you can look at a chart and say a company was selling for $200 in this year or this day, and now it's selling for $5. It's a reason why it's selling for $5 now. It doesn't necessarily mean it's going to go back up to $200. They probably was bringing in more revenue at $200, and they're probably bringing in less revenue at the $5 price point. Like Ford, for example, was selling at $9, and after the panic happened or the pandemic, it's selling at $2 to $5 now. They're losing money, and that's what you want to look at. All right, once you got the ticker symbol and you enter in Google or whatever, your brokerage account, once you search the ticker symbol, look up the company, the first question you need to ask yourself before you even start looking into companies and investing is, are you going to do this for short term or long term? So once you got the symbol and you answer that question, you look up the ticker symbol and you have what's called a market cap. You might notice it. If you don't, look for what's called a market cap, MKTCAP. And it's pretty much broken into small, medium, or large. So a small market cap will be any company with a market cap of 300 million to 2 billion. A medium size would be 2 billion to 10 billion. And a large market cap is 10 billion or greater. And pretty much what a market cap is all the shares that that company has out in circulation, circling around. If you add them all up, that's what you get for that market cap. And that's pretty much money that the company can use to invest in other things. So another thing after that, you might want to look into the PE ratio. And so the PE ratio is called the price to earnings. And so the price to earnings is divided into multiples. So the average PE ratio for a company would be like 25 or up to 30, but 30 might be considered overpriced. And so how you judge a PE is you want to look for a company in a multiple of 15 to 20, and that's really good. That means you're not overpaying for a company. And anything 25 and up to 30 is kind of looked at like you're overpaying a company. But since the PE ratio is pretty much the share price divided by the earnings, so how much a company is earning versus how much you're paying for the share, sometimes they might be expected to bring in more earnings, and so that price to earnings might not catch up with it yet. So you might see a PE ratio of 30 or higher, but the expectation for that company to bring in more money would just be there without the company actually bringing in yet. But you want to look for something low. That means you're not paying or overpaying for that stock. So once you got your brokerage account, you got your ticker symbol, you've looked at the market cap, you looked at the price to earnings ratio. After that, you want to look at the earnings per share. So earnings per share is pretty much self-explanatory. It's the profit that the company brings in over the whole year and divided amongst all the shares that they have. And so you want to look at something like at least bringing in more than $2 earnings per share. I'm just saying, like, you want a company that's making profit, because that profit translates into dividends, and that's if you're looking into a company that has dividends. Now, I want to say, full disclosure, not every company pays out dividends. But my advice is to find companies that do pay out dividends. So a dividend is a company pretty much giving you money for holding on to their shares. So you'll receive those payments quarterly, so that's every 3 months, but some companies pay out monthly. It depends on what company you're investing in, you can find that out. But let's say you get $100 for the year, they'll give it to you in quarters over every 3 months. So that's $25 the first quarter, $25 the second quarter, $25 third and fourth, until you equal up to that $100 payout. And they'll also let you know what's called an ex-dividend date. And that pretty much means by that date, however many shares you have, that will be the percentage of the payout that you get. So once you got your brokerage account and you found the ticker symbol for the company you want to invest in, you've looked at the market cap, you've looked into the price to earnings ratio, and remember, the price to earnings ratio, the lower the number, the better, because if the number is too high, that can pretty much mean that you might be overpaying for that stock or that company. Then you want to look at the earnings per share, then the dividend ratio, and that's if the company pays a dividend. Once you did all that, before you complete your purchase, there's a couple things you want to look into. So you want to look into the management of the company, because you want to make sure that the company isn't being mismanaged and the CEOs aren't overpaying themselves. And then you want to print off what's called a 10K. So I have an example of a 10K. Pretty much a 10K is an annual report that the company files with the SEC, and it pretty much shows everything that the company is doing. So this is an example of a 10K. This is Delta, and pretty much is everything in here: the balance sheet, the income statement, the cash flow statement. So this shows you everywhere the money's coming from and everywhere that the money's going. And this is just one example of a 10K. But this will be another example of a 10K, and this is Discover Financial Services, Discover card pretty much. And so you want to read through this, and this is pretty simple. It's like, it explains itself. They even have notes in here explaining some of the stuff that's in the 10K. And then once you read through the 10K, you might have to read through it once or twice just to get a complete understanding. You want to print off what's called a 10Q, and the 10Q will be a quarterly report that the company files. So you want to pull off the most recent 10Q, and you want to pull off the last year's 10K. Thank you for watching the first video of Failsafe Wealth. My name is Terry. If you enjoyed the video, hit the subscribe button so I can get my followers up, and more videos will come where I'll go into detail about a mutual fund, an index fund, ETF, a bond, and other ways to diversify your portfolio, and pretty much also other ways to create other streams of income. And thanks for watching. Let's get it, let's do it.